How different would your life be if you owned the bank?
The bank collected 520 and they paid out 20. How much better did the bank do than you in this deal? We got to think like the business owner. So it's not about the dollar amount. We always think about it in percentages, right? What was our percent return, right? Just know we're going to take 520, divide that by 20. That's 26 times. That means the bank did 2,600% better than us, but they did it with your money. They have no money in the deal.
In order to get there, though, you first got to be willing to think differently.
No, I just challenge everyone to be willing to rethink your thinking. Just Nelson left us with that gift. That's biblical. Be renewed in our minds, right? Like, just be willing to rethink your thinking and open to new ideas and be curious about solving problems that maybe you didn't even know existed.
All that and more on this episode 490 of the Working Cows podcast, brought to you by the Rogue Food Conference.
Welcome to the podcast that gives producers a platform to discuss and share paradigm-challenging practices. Practices that have increased the effectiveness of their operation and the joy that their families have received from this lifestyle.
Howdy, everybody. This is Clay Connery, host of the Working Cows podcast. Very excited to be joined today by a new friend, I'll call him, Nick Kosko. It's kind of a crazy story about how I got connected with Nick, and an even crazier story about Nick's connection to the Rogue Food Conference. And if you come to the Rogue Food Conference, maybe I can tell you that, or maybe I'll tell it in the outro of today's episode. But in any case, Nick is an IBC practitioner, that is Infinite Banking Concept, and a guy who is helping people get set up to start doing that for themselves. And him and Kyle Reese will be at the Rogue Food Conference coming your way February 5th through the 7th in Rapid City, South Dakota. Not too late to get tickets. There are still tickets available. It is happening at the same time as the Rapid City Stock Show and Rodeo Rapid City. That event brings 300,000 people to Western South Dakota during the 10 days of the stock show, making it the second biggest event in the state outside of the Sturgis Motorcycle Rally. So it's a big event. Top 10 rodeo, actually, again, for the sixth time, I think it was, Rodeo of the Year this year, the large indoor rodeo of the year. So if you're interested in that, come on out and join us at the First Baptist Church in Rapid City, South Dakota, February 5th through the 7th. Tickets are available at roguefoodconference.com, and use the code COWS30 for $30 off your ticket. We hope to see you there. So for now, here is my conversation with Nick Kosko. Nick, thanks for joining me today on the Working Cows podcast.
Thank you for having me. It's a pleasure.
Yeah, and been a while since we've broached the IBC topic. That's Infinite Banking Concept. So I guess where I'd like to start maybe is we'll start with kind of a high level or even a detailed introduction to the topic, and then maybe we'll talk about some of the misconceptions or fake news, maybe, as it were, that's out there about IBC. So where would you start if you were trying to explain IBC to somebody for the first time?
Well, I think it starts with being curious. Okay. I like to think of it signal versus noise, and what's going on in the landscape of this world. How about this? I'll just give you a little bit of my backstory, how I got here. You've got kids, I've got kids. The central theme here is our kids asking why. And what are they trying to do? They're really trying to just learn the truth, not your convenient truth, or in too many instances, Clay, it's the convenient lies that swirl around that are for somebody else's benefit, not ours. So I'm 49 years old at this recording here in, what are we in, 2026? 20 years ago, I got my dream job flying a 747 around the world. I was working for a Fortune 50 company. Basically had it made. My feet didn't touch the ground. I was levitating around town here in Louisville, Kentucky. It was awesome. Making really good money, but the downside was, we had a world economic collapse, just about completely, thanks to a little office in London under the title of AIG. and their derivatives division just about brought down the world economy, right? And that had a ripple effect, and it took a while. And even Fortune 50 companies laid off people that were previously thought to be unlayoffable. So my well-paying job 3 years later, right after my wife told me she was pregnant with our first, was coming to an unexpected end with a return date of Lord knows what. And it was one of the greatest gifts God's ever given me because it woke me up to the financial industry. And I was curious. I realized I was a well-paid slave, and that term can be disturbing to some people, but I was exchanging time for money for somebody else's benefit, and they gave me just enough to keep me happy, right? And so my wife and I went and did Dave Ramsey's financial noise. I always mess that up. Financial peace course, and we sold our cars, we bought clunkers, we moved out of our house, we bought a fixer upper, we did all the things to like tighten up the ship. And a couple years later, I got my flying job back, and I went and paid cash for a couple cars that we had saved up, and we now got a couple kids, and I'll never forget, Clay. I paid 40 grand for two 3-year-old reliable cars for my wife and I. And man, my entrepreneurial senses just were like screaming at me, like, man, that 40,000, I'm never going to earn interest on that again. Like, but Dave told me I should be excited about it, and I wasn't even sort of excited. And I'll be honest with you, like there was this like internal like grit, right? And if you've ever felt that way, you're like, man, I know there's a problem with what I just did. I can't put my finger on the problem, and I sure as heck have no idea what the solution is. So if you've ever been there, anybody listening, keep listening, okay? Because remember, it's like, why? Why does this not feel right to me? Okay. Because usually when you're flying an airplane, there is a real thing called the seat of the pants. Like if you think something's off, it's probably off. Okay. So you need to check that out. So I started interviewing financial advisors here. And Clay, I interviewed with a bunch of guys that were great dudes I'd probably have a bourbon with, probably go play golf with, hang out. But I just kept thinking, man, I think all of this financial stuff you're showing me, put my money in a good growth stock mutual fund and blah, 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 blah. Like, I think that's for your benefit, not mine. Again, not smart enough to put my finger on what's the problem, but I'm like, I think there's more to this. And I just kept scratching and clawing. And so, Clay, one night we take off out of Louisville. We're going to Denver. It's like 4 a.m. I'll never forget this guy. His name's Mike. All right. And I say all this to him about my frustrations about money and the financial system and what is going on. And Clay, he goes, well, have you ever heard of infinite banking? And I was like, what? I don't know what you just said. So you can just picture us. We're flying west out of Louisville, and we get to like Missouri. We're at the top of climb, and we're getting settled in. And I just start peppering him with questions. And he's a new client. I mean, this is like 14 years ago. Clay, he's a new client of somebody who's now a really good friend of mine. Actually, we do a Bible devotional every morning together, this guy and I. He's down in Alabama, and he was really good friends with Nelson Nash, the author of the book, Becoming Your Own Banker.
Yeah, episode 92 of the Working Cows podcast, if anybody wants to listen.
Yeah. You had Nelson on, didn't you?
Yes. Yep.
Yeah, Nelson, one of my favorite human beings of all time. Yep. And so I could go down that rabbit hole, but I'll stay on track here. I'll stay on course, right? So we're flying along, and I'm trying to get to the end of the internet with Mike here about what infinite banking is, but he can't answer any of my questions very well because he's too new at it. But I remember him showing me this insurance policy, this whole life insurance policy, putting 70 grand a year into it. And I was like, Mike, but Dave tells me to buy term, invest the difference. And he's like, no, Nick, it's not about the insurance. And I'm like, no, Mike, it's like blah, blah, blah. Like, we're going back and forth. And this goes on, Clay, for 3 nights in a row. He's like, Nick, you just got to read the book. So I finally get the book, Becoming Your Own Banker, Nelson's book. Interesting you said episode 92 because the book is 92 pages long. It's small words, big font. I know you didn't know that, did you?
No.
Nope, but it's not by chance, right? I'm sure Nelson, the irony was not lost on Nelson. He didn't miss those details. But So I'm reading this book and it's small words, big font, something even I could understand. And I was like, this is what I've been looking for. And I got Nelson on the phone. And I said, Nelson, nobody in the state of Kentucky's certified to teach this. I need help understanding this. And in fact, I think I want to take this message. I'm pretty sure God is not giving me this message for me to just do with myself. And he says, all right. So long story short, I get certified. I asked him for a mentor. He says, Nick, you don't need a mentor. Now, keep in mind, he flew airplanes for like 60 years. And so because we had this common bond in aviation, he instantly overliked me. Okay. He gave me entirely too much credit as an aviator. I was like, Nelson, I've completely fooled you. I have no idea how to communicate the message in your book to another living being. I need help. And he's like, all right. So he has this guy, Jim Oliver, call me. And I can tell you within a couple square inches of where I was standing in a house that I lived 4 moves ago. When Jim and I talked and he flipped my world upside down, he asked me question after question after question that completely convinced me that I knew nothing about money, that I needed to shut up and listen. I needed to do exactly what Nelson said. I needed to be willing to be 100% wrong about everything I'd ever thought I knew about money. And honestly, if you're not willing to be wrong about the way you're handling your money and think about money, then I would encourage you to move on to the next episode of the Working Cows podcast. But if maybe you think you could learn something, keep listening, because that's what I did. I was just like I had really little kids at the time who were asking me why all the time. My oldest is 16. So I got into this 14 years ago and I've got 4 kids. So I've been through a lot of reminders of just keep asking why. Right. And, what I learned was the rest of the story about how money works. I learned that the financial industry wants your money, right? Clay, how much of your money do they want?
All of it.
How long do they want it?
Forever.
And how much do they want to get back to you?
Nothing.
All right. I appreciate all your answers, but who's they?
I don't know.
Yeah, the banks, Wall Street, and the government.
Yeah.
So they know something we don't. They don't tell us this, but it's about control, right?
Yeah.
They want control of your money for as long as you'll let them, and they pay us back. Remember I said I was a well-paid slave? I don't fly anymore. I haven't flown an airplane in 5 years. I flew airplanes for enough money to keep me at that job, right? What do? What's this quote unquote return that we get from the bank, from Wall Street? It's just enough to keep us from rioting, right?
Mm-hmm.
But they don't have any money in the game. They use something called leverage, right? They use our money. So, any questions so far before we?
Yeah, lots, but
yeah. Why don't you? I'm gonna take a sip.
Yep.
What do you have so far?
Let's take a quick break and hear a word from our sponsor today, the Rogue Food Conference.
Are you ready to take back your food sovereignty, your productive liberty, your ranching heritage, or how about your freedom? If you are, join us at the Rogue Food Conference coming to Rapid City, South Dakota, February 5th through the 7th. Connect with us at the First Baptist Church for 3 days of game-changing information and talks of food, ranching, and finance. Hi, I'm Shad Sullivan, and I'll be bringing Freedom's Theme along with regenerative food and ag trailblazers like Joel Salatin, John Moody, Ellen Bench, and Steve Campbell. Daily lunch featuring locally sourced products will be served from noon to 1:30 and is included in ticket prices. Don't delay. Get your tickets today and join the movement at roguefoodconference.com. For $30 off, use my code SHAD30, that's SHAD30 at checkout. We'll see you there.
I would like to know if you remember some of the questions that Jim asked you that prove that you didn't know anything about money.
So he goes, how much money are you making? I said, at the time I was making like 150 grand a year flying an airplane. I was a first officer, domestic first officer. He goes, is that common or uncommon money? Now, I was such a knucklehead. I was like, well, That's common money. They're paying me in US dollars. And I was trying to outsmart the whole thing. And he goes, no, that's an uncommon amount of money. I was like, oh, yeah, you're right. It is in the grand scheme of things, right? It's an
It's
uncommon
high.
amount.
Is that what you mean by that? It's a
Yeah.
good. Yeah. Right.
Yeah.
Right, I'm with you.
Yeah. I don't know what the low ball number is for people anymore, but he goes, so if that's the case, why would you want to do common things with your money?
Hmm.
And I was like, tell me more. He goes, why would you want to put money into a 401k and a Roth? He's like, that's what normal people are doing. And I was like, I kind of pushed back a little bit. And then he asked me these 3 questions. He said, are taxes going up or down in the future? And I said, up. Clay, I'll ask you, are the dollars in your pocket worth more today or in the future?
Today.
And would you rather pay tax on the seed or the harvest, the little number or the big number?
Yeah, the seed for sure.
So all that flies in the face of people putting money into a 401k.
Mm-hmm.
So you give up control of money for, let's look at a window of time between ages 20 and 80. Okay. You put money into an account, you get use of the dollars for roughly 10 years between ages 59 and a half and 70 and change. So you get a 10-year window where you can access that money without penalty. Because after age 70, you got required minimum distributions. Well, what do they know? Well, they want the tax on the money. They make you take it out, right? So Nelson, he said, hey, is there a government program that's ever wound up working? No. In fact, he went so far as to say they all wind up doing the exact opposite of what they were intended to do. They have a 100% fail rate.
Yeah. That's true. Yeah, the Department of Education, not a roaring success. The Food and Drug Administration, we just completely flipped the food pyramid on its head. You know, and that was dogma for 40 years. You couldn't question it. So it's like, really?
Yeah. Yeah. So
just now say the exact opposite and pretend that we never said any of the other stuff before. Really?
Yeah. So like, if the 401k, that's not some private business came up with that. That's in the tax code. It's
a tax shelter. That's what it is. It's a tax shelter.
Temporarily.
Right.
Right.
I mean, that's how they pitch it. I don't know what it actually is.
Yeah.
Pitch it.
And the guy who designed it said, hey, this was never supposed to be like the whole shooting match. Like, this is not the 8th wonder of the world, right? But it's sold as the 8th wonder of the world. But my golly, question somebody putting the money in that they're getting matched. God forbid they're wrong on that math, right? But hey, we can do that math for you. We can show you how that match money may not actually be what you think it is. So just, the 401k, the Roth, those are all government creatures, right? And if they're designed, are they really going to wind up doing what they were designed to do? What's the odds that they're the first government program to do what they were designed to do? It's pretty low, right?
Right.
So those are the things that Jim broached with me, was just challenging my thinking on the traditional models. And Nelson he gets into that in his book, right? And I already broached one thing, which was our willingness to be wrong. Nelson talked about the arrival syndrome.
Mm.
Do you already know everything? I mean, what's the odds that the farmers that are going to be at our Rogue event know everything? Well, they're there to learn. Right? If they knew everything, they probably wouldn't show up. So that's what I love about, like, it's an abundant mindset, right? Like, hey, I'm willing to be wrong, right? And then, Nelson walks through his problems there in his book in, the golden rule, Willie Sutton's law. Willie Sutton was a famous bank robber, and he got caught, and they said, Willie, why do you keep robbing the banks? He's like, that's where they keep the money. And it's like, oh, wait a second. How much money is in the 401k system? Has anybody looked at the deficit that we got going on?
Mm-hmm.
There's a place they can go get the money. Oh, they would never do that. Oh, they would never confiscate your gold either. Oh, and guess what? They're never going to tax Social Security. Like, I'm sorry, the track record's not good. So listen, if you think the government is your best friend and that they're here to protect you, then go sit down with their money babysitter, put all your money in your good growth stock mutual fund. And then when you retire, you can sit down with them and they'll tell you how much money you can take out each year. And you can hope that you don't run out before you die. Right? Hey, and I know infinite banking will work for everyone. It's just that not everyone's willing to think differently. And that's fair.
So what is the strategy then? So how do we take the other approach, whatever illustration from previous media, how do we take the road less traveled? How do we take the red pill? How do we take whatever? How do we what's the approach?
Yeah, so the first thing we got to do is, how does the bank work? All right, because if we're going to be our own banker, then we probably should know how the bank works. Okay, so let's just walk through this. And if you're at home and you want to draw this, or you can go find this, we can get you a link to a video of me drawing this out. But Shakespeare said, if we know the players in the play, we'll know what's going on. Okay, so let's just walk through how the bank works, and then you can decide whether or not you want to be the owner or not. So we have a depositor. It's player one. Okay. Now, Clay, when you go down and deposit money at the bank, is that an asset or a liability to the bank?
It is an asset.
All right. Don't feel bad. Everybody answers it wrong, except for the guy that works at the bank and the CPAs. Okay. It's actually a liability. And here's why: because you're actually a creditor of the bank and they got to pay you back whenever you ask for it.
Sure.
Okay. What's the asset is the loan. Okay. So the borrower, there's another player in the play. Okay. So the bank goes and lends money to the borrower. The borrower pays interest back to the bank. The bank is so kind, they pay us a little bit of arbitrage in that, and we're happy. All right. But remember, there's another player in this, and that's the bank owner. Okay. So there's three players: the depositor, the owner, and the borrower. Okay. All right, so we have this flow going on, but let's apply some numbers to it. So Clay, you deposit $10,000 at the bank. And before I go on, like, we have people that put $10,000 a year into their policies, and we have people that put millions of dollars a year. Okay. If it works for a little number, it works for a big number. So let's just say the bank pays you 0.2% interest. So that's a whopping $20 that they pay you to keep your $10,000. Now they take your $10,000 and they go sell it for anywhere between 4 and 28%. You're like, wait a second, what do you mean 28%? Well, just think of your Home Depot card. Okay, any unsecured line of credit, it's going to be upwards of 28%. But I'm going to use an average of 5.2%, and I'll tell you why here in a minute. That means that they're going to collect $520 of interest on that loan. Okay, so Clay, I'm putting you on the spot to do math. Don't feel bad. The bank collected 520 and they paid out 20. How much better did the bank do than you in this deal?
$500.
All right. Again, don't feel bad. We got to think like the business owner. So it's not about the dollar amount. We always think about it in percentages, right?
Yeah. Right.
Right. What was our percent return? Right. So thanks for playing along, because I know you're a smart guy. So just know we're going to take 520, divide that by 20. That's 26 times.
Yep.
That means the bank did 2,600% better than us, but they did it with your money. They have no money in the deal. All right. I don't know about you, but that irritates me that somebody can make that type of money off my money. But there's a solution. Oh, before I get there, those numbers sound kind of crazy, right? Like a little unbelievable. Those are actually Bank of America's numbers from a few years ago. And we have a report referenced on our stuff. It's called, there's a company called Bauer Financial Report. They actually analyze bank and financial institutions. They actually say very carefully. It's pretty funny. But they do this for everyone. You can go buy the reports and look at them. And it really doesn't matter much how the interest rates move. Banks actually make more money when interest rates are lower, based on that. How many times does it go in? Whatnot. But So now we know how the bank move. Like that's that flow of money. Okay. That depositor, the borrower back to the bank, and the bank back to the depositor. But if the owner made all that money, made the 2,600%, wouldn't you want to be the owner of that? Infinite banking is as simple as putting a wall around it all so that nothing can leave the system. And Nelson said, listen, you can do this whole process with a shoebox full of cash. It's about the process, not the product. So anybody that thinks, hey, I've already heard this, like I'm not buying life insurance. This is another way to sell life insurance. Go for it. Do it with cash. Just be an honest banker and charge yourself the interest. He said, listen, you can do this with a shoebox full of cash. He's got an example in his book about somebody doing it with a CD versus the insurance policy. You can do it with a brokerage account, but the most ideal platform is a very specifically designed dividend paying whole life policy with a mutual company. And there's a lot of reasons why we would do that versus the 100 alternatives. And we can get into that, but that's the 10,000 foot view. Is we just want to understand that process, because Wall Street, the insurance companies, the government, they're all doing that process. So so far, we just have to think about, do I want to be the owner or do I want to be the customer of the bank? And infinite banking, Clay, is really just solving one problem for us, the general consumer. And that is that we finance everything that we buy. So, Clay, do you agree with that statement?
Yeah, the consumer debt, there's a lot of it. Is that basically what you're saying?
Well, what if you paid $100,000 for a piece of equipment? Do you think? What if you paid cash for that?
There's an opportunity cost on that.
Okay, perfect. So those of you that are like, hey, wait a second. So it's really easy to see this when we have an amortization sheet, right? If we finance something, 30-year mortgage, 5%, those are easy things to see. But what stumbles or trips people up is when we pay cash and the impact of paying cash. So let's just say you had $100,000 in an account and it was earning you 4%. So let's just say it was in a high yield savings account earning 4%. And we looked at that over a 30-year time period. Now, I don't know what this number is off the top of my head. I apologize. I just don't remember. But it's in the neighborhood of $200,000 in interest that you would earn over 30 years if you just earned 4% on that and never contributed another dollar. But what if you spent that $100,000 of cash? Now you don't get to make that 4%. Pick your time horizon. It doesn't matter. It has a cost. And that's what Nelson was saying. Is listen, paying cash has a cost. So if we can't agree upon that, then again, this is your opportunity to off-ramp. But maybe, just maybe, we could explore the solution. And all Nelson was saying was, hey, infinite banking, we're just going to solve that problem, because all that interest that you're paying to other people, you could collect in a tax shelter, and all the interest that you were going to lose by paying cash, you could collect into a tax shelter. The tax shelter being this very uniquely designed life insurance contract. So I love the fact that if we just think about solving a problem, it opens our eyes, right? I'm intrigued about solving problems. So far, so good. Questions?
Yep.
I've been talking for a minute.
Well, you mentioned Dave Ramsey. I'll mention him again. He's no friend of IBC. He's actually been an opponent of it for a long time. But one thing that he does point out frequently is that's why the banks always have the biggest buildings, right?
Yep.
They're making this return, the 2,600% you mentioned, so he understands at least that concept of it, and maybe doesn't go any farther than that, but that is, I think, another witness on the stand in favor of what you're saying, right?
Yeah. In fact, in his famous video on YouTube, Land Blasting Infinite Banking, he actually doesn't address the really what we do. I actually am really good friends with someone who has pursued a live debate with him on multiple occasions, and Dave won't do it.
Yep. It's not
It's
Bob
always a red
Murphy, is
flag.
it?
No, it's not. Yeah, I know Bob too.
Yep.
Yeah, he's a funny dude. That would be interesting as well. But
Yes.
this guy's just a practitioner who's really well spoken and very experienced.
Nice. Gotcha. Okay, so and the other thing that came to mind while you were talking was the fractional reserve nature of banking as it operates currently in our system, and the fact that they don't have to have all the money that they have on deposit in the building, and the issues related to that. I don't know if there's anything there that you'd like to explore, but that is
Yeah, those things are inherent problems. The fractional reserve, if you're not familiar with that, is the bank gets $1 and then they can lend out essentially $10. Their reserve limit is not even 10% right now. I don't want to speak out of school. I just know it's a lot lower than that, or it was not too long ago a lot lower. It's not something I personally track, but it's their ability to essentially print money out of thin air, right? So they can, and then it basically gets hypothecated down. I'm using that. Don't phone me and tell me I used the word hypothecation incorrectly. It's just that once they lend out some, then they can lend out another 90% and 90% of the $80, and it just works its way down. It becomes quite bastardized, your dollars, and how much is out in circulation. So if we remember a couple years ago, there was a run on a bank out in California. Why did the bank care?
Yeah.
Well, because they don't have the money sitting there. So it's kind of interesting. People ask this a lot because we're going to get into what these insurance companies are, but the banks, people think, well, I'm FDIC insured. All right, cute idea. The FDIC has less than 1% of its liabilities on hand in cash. And the Dodd-Frank Act that was passed after the '08 debacle says they can't go back to the American public to fund the FDIC when there's more banks failing than there's cash on hand. So how good do you feel about your more than 250,000 sitting in an account, or any dollar sitting in there? That doesn't, I'm sorry, less than 250,000 sitting there. I said that backwards, but yeah, good luck. Hey, if you want to take that chance, knock yourself out, just understand. It always cracks me up, the bank I go to all the time here in town, because I have a bank of convenience. I own multiple businesses. Like, we have accounts receivable, accounts payable. They flow through something, and I stand at the teller window in clay, literally right at my eye level. You know how it's got the cutout and comes down, and the window, and then it's taller on either side. It's got this FDIC thing, and they actually have a camera hidden in there, so it's kind of always funny. In the D of the FDIC, there's a camera in there. I always wave to it, but it's telling me, backed by the good faith and credit of the FDIC or something like that. I just always internally chuckle. It's like, cool. I asked the teller one time, I was like, the FDIC has less than 1% of the liabilities on hand in cash. They looked at me as if I just burned down an orphanage. Had no idea what I just said.
Yeah, for sure. So, okay, what percentages, or what is kind of a good place to start, or a healthy approach to this, to get going, and then kind of building on that, kind of the long-term strategy? What does that look like?
Yeah. So, like, I always just think, like, how much of your money do you want to control? Some of it, all of it, a little bit of it. Like, how good do you feel about being a customer of other people's financial institutions? We have people that come in and say, hey, I'm paying $150,000 a year, $250,000 a year in taxes. And I say, well, I could show you a strategy where we actually fund your life insurance policy, and we run all this money through a policy first before you pay the IRS. All that money's in a tax shelter. After a few years, every dollar you put into the policy, you get more than $1 to use, which is a net reduction in the dollars you got to come up with to go pay your taxes. What if effectively the IRS could fund your banking system? Like, what would that interest you? What about all that equipment that you're financing? those giant tractors. Let's look at the lease on that. Let's look at the financing on that. What if we took over that stuff? It's different for everyone. You start where you can start. Where's the cash that you have? Like, we build these things so you can use them right away. Like, we just started working with a decent sized rancher out there in Montana, and the way that we're able to fund the policy with them, they're turning around and taking loans from it immediately with a significant amount of cash position in it for their operations before they have their accounts receivables available in 9 months. Like, it's pretty cool. But a lot of times, Clay, what we look at is people will say, hey, I've got money in an old IRA. We've got money in capital accounts. We've got brokerage accounts sitting here. I'm sick and tired of this money babysitter. Literally, Clay, I had somebody say, I got like 15,000. And this person was like 19 years old. Just a hardworking young girl who just cleans for people. She had 15,000 in her freezer. She hated the bank so much. Right? Like, it's just always funny, like where people are. Then we have a client that has almost 800,000 a month in escrow for his real estate portfolio. Like, what's that look like to flow it through? A banking system, something that you own and control. Because what we need to understand is the power of these insurance companies. Okay. So let's talk about that, because ownership has privileges, right? So I would say a lot of people that are your listeners, they prefer to own their home than rent their home. And with that comes, I can paint when I want. I could tear down a wall if I wanted, right? I can choose to mow the grass or not mow the grass, like whatever I want to do, right? I get privileges. I don't have to ask anybody else, can I do these things? But if I was a renter, it's totally different, right? So what we have to understand is, what are we doing with these insurance companies? I need a depositor, right? So I'm gonna put a certain amount of money that I choose to into this policy, but I'm partnering with an insurance company. Now, not just anyone. We're going to look for insurance companies that have been around for 100+ years, have been profitable for 100+ years, really high statutory reserves. Not this less than 1% thing. We're talking about going the other way, like having 110% reserves, like insanely financially stable. Okay. But do you know the difference between a stock company and a mutual company, Clay?
Nope.
So all these companies are owned by somebody, right? So it's just the difference of who. So like AIG, there's a stock company, so that we could buy stock in that company, and when they're profitable, they're going to pay a dividend. They pay us something. But the mutual insurance companies are only owned by its policyholders. Interesting. So Clay, if you owned a grocery store and I owned a grocery store, whose would you shop at?
Probably mine.
Yeah. Would you fill the grocery cart up and go out the back door and steal the groceries, or would you go out the front door and pay for them?
You gotta pay for them.
Yeah. All right, cool. So you're going to be an honest customer of your bank, right? So these financial institutions, these mutual insurance companies, are just large financial institutions that we're now going to shop for money from. Okay. So I put money into the policy. It's now going to grow for me, tax-free, uninterrupted. The power of compound interest. Okay. When I go take a loan from it, so if you go to the commercial bank and take a loan because we're the customer, first and foremost, they can say no, right? And if we wanted to take a loan, it's a pain in the butt, right? I got to fill out how many pages? I got to tell them when I'm going to pay them back. What's my credit? What's my collateral? All of that, right? But when I take a loan from the insurance company that I have ownership in, Nelson taught us, he's like, listen, just look at the contract. Look at the provisions in the contract. The contract says I get an interest only, unstructured loan. So Clay, let's just say you had a piece of equipment. You had a big piece of farming equipment, and you had a tough year, and you had trouble making payment on that, and you had the loan was with John Deere. What do they do when you stop making payments?
They come get your machine.
They come get your machine. That's because you're a customer and you're not in control. Okay. You forfeited control. But if you had financed that through your own banking system, if you don't make a payment, they don't come and take your machine because you're the owner of the bank. Okay. That interest only loan, I just pay the interest once a year. I was going to pay the interest anyway. Okay. And I'm paying it to a financial institution I have ownership in. So, like you said, you're going to go out the front door, pay for the groceries. So I'm going to go out the front door and pay for the money. But more importantly, it's unstructured, meaning I can pay it back whenever I want. So I go buy this piece of equipment that's part of my business. Now, I'm not a CPA and I'm not an attorney, and I'm not going to give advice on either. But you can confer with yours, and if they disagree with what I'm about ready to say, I can get on the phone and explain it to them. But that interest that you would pay the insurance company on that loan for that business purchase would be tax deductible. But your money never left the system because all they did was place a lien on your money in the policy. So it's earning interest tax-free, and the dollars that you spent on this was a tax write-off. And most likely, that piece of equipment is making you money. So instead of buying the equipment and just using the bank and that money being either or, like it's either in your checking account or it's in the piece of equipment, I get the money in my policy growing for me tax-free, and I get to go buy it. I get both. And it's kind of a paradigm shift about how we think about money. So I could draw this all out, and I will when we're in Rapid City, and I can direct you to a resource too for your audience. But it's really understanding the problem. It's this problem of being a customer. It's a problem of not being in control and saying whether or not you want to solve it or not. And what we do, we just coach people along the way. We don't charge for our coaching. You can't call the insurance company and buy these products on your own. So we're a conduit for it. We set it up just the way we would set it up for ourselves. And then we coach people along the way to use it.
Are there limits, or what's kind of the scale at which this is doable?
Well, it's all a function of death benefit. At the end of the day, you can have 99 million of death benefit on yourself. Most people have a hard time getting that far. Usually we have clients that put millions of dollars a year into their policies. So there's an oil and gas tycoon in Oklahoma. He puts $800,000 a month into his banking system, and that's probably scratching the surface of what he could do. So there's limits like that. But then you look at all your insurable interests. It's partners in your entities, your businesses, your family, the legacy benefit, like a good man leaves an inheritance to his children's children, right?
Mm-hmm.
So the multi level approach to this, my kids, someday my grandkids, great grandkids, all of that. So those are all insurable interests. So it's not just on us, the dad.
Yep. And just kind of, can you walk through how it works, or what the process is, and kind of how people move forward, I guess?
Yeah. So what we do is we'll sit down with someone. Here in front of me, I've got this big drawing board, this digital drawing board, and we meet with the clients all over the country. And here's what I always just tell people, Clay, is I will sit and answer your questions as long as you're doing the homework, as long as you're a willing participant. We have tons of resources. Nelson had great resources. Our firm has a couple books that resonate with different people, but we'll just keep answering your questions and helping you decide whether this is for you or not for you. Clay, at some point, people generally go, okay, you've patiently answered all my questions over the last 10 meetings, whatever. Sometimes people need a half a meeting, right? They've already figured out, they're like in. And then there's people that need 10 meetings to get all their questions answered. And they tell us, hey, I want to put in $50,000 a year. I want to put in $250,000, whatever that is. And then we do an application. We ask the insurance company to insure you. We're not married to any one insurance company. Can write with any of them that are worth a darn. Most of them I won't write with because there's the unseens about them as well. I've been pretty blessed to be exposed to that side of the business and place people with the right companies. We get you approved. We do all that, and then we sit down and we walk through a implementation strategy with our clients and walk along the way. Like, we're super accessible and love doing this.
Are there minimums that you would say, hey, wait until you're at this point before you get started, or yeah?
Yeah, it kind of depends on ages, but I would say generally, as a rule of thumb, be able to put like 10 grand a year into it at a minimum. Your typical business owner solving a bigger problem, whether that's 25,000, 225,000, it doesn't really matter to us. We're going to build it for the maximum amount of cash value and the lowest amount of death benefit. And we're going to walk you through why we do it like this. Any of your listeners that have read Becoming Your Own Banker, you can walk through all of Nelson's examples in there and the general framework of construction. We're Nelson Nash purists. The one thing, Clay, that I've learned, and especially the last 5 years, it seems like everybody that has the ability to boost post and make their stuff more visible is doing that, but that doesn't mean they know what they're doing. And I'm seeing a lot of little bit of sales chicanery going on, people tricking out insurance policies. And I don't think it's not intentionally nefarious. He passed away 7 years ago. Unfortunately, his message has been diluted a little bit. He's not there to browbeat people personally, because he'd grab you by the ear and say, hey, why are you doing that? I can't do his Alabama drawl. I'm not even going to try. But he was a staunch supporter of the truth. He did not like people, quote unquote, tricking out these policies. I can tell you on good authority, the insurance companies don't like what some people are doing with these policies. Although they take the money, what they're saying is, hey, you're making this look really good at the beginning, and that has a problem downrange. And we're not getting, I can't tell you you're not going to have a problem. And what I'm saying is, well, I'm going audiences, there's this thing called the modified endowment contract. And what that means is that it now acts like a qualified plan. You can't use it the way that you want to. And those loans will be taxed as distributions. And that comes with a problem. And when you see people making things that look a little too good to be true, you need to ask yourself some questions. Like, I see people putting in these huge dump-ins at the beginning of the policies and a little bit of premium going down the road. Like, these all fly in the face of what Nelson taught. They fly in the face of all the examples Nelson put in his book. So we've not wavered ever in how we build these things. Do we lose business sometimes? Yeah, because people got some pretty fancy sales pitches. I'm not in the business of fielding calls from angry customers 5-10 years from now when their policy's going to mech because they can't drop the term rider. The term rider's getting expensive. They didn't fund it the way they said they were going to, like all the things, right? Nelson said, listen, if you hadn't done that, you wouldn't have these problems. So, and even worse is the people selling universal life. I wouldn't sell that to my worst enemy. And that's a whole nother rabbit hole. I would just tell you that's really great for the people selling it. It's really great for the insurance company. It's really not great for the consumer. But by the time you figure that out, it's going to likely be too late. So
integrity is a thing, right?
Well, it is a thing. And here's what I'll tell you. I play golf. Like, I'm a golf junkie. Jim, my business partner in this, is a golf junkie too. And, we have great friends that sell this stuff. And what we find is they literally just were not taught this. The industry, it's a relatively predatory industry, and it's not the end guy that is the bad guy. We had a meeting today with this guy. This guy does trust strategies. Really intriguing how he sets up these trusts. It was a little different than any way else I'd ever been told. And he laid this out, Clay, today, that he's going down talking about premium finance, which is when you borrow from a bank to fund your life insurance contracts, which is most likely not a good idea for anybody listening to this. Okay. It would be a really good idea if I went and got well versed and convinced your audience to do premium financing, because I'd make a lot of money. But I know enough about this to know that it's generally not good for the consumer. Okay. And this guy was like, oh, yeah, universal life, it's got a place, it's a solution. And Jim and I both just started asking him questions. And the guy's like, okay, maybe there's something for me to learn here. And it's just out of ignorance. The industry is not set up to educate the end users. And it's not your truth or my truth. It's just the truth, right? Like, that's what we want so we can make the best decisions. Like the Bible, right? Like, I remember in my faith walk along the way here, which is not too too distant in my evolution of like my epiphany about all this. But I remember in 2020, really quickly, probably like you, kind of called shenanigans, right?
Mhm.
And I was talking to my pastor, who was a little bit bought in on what was going on. And I said, hey, Brian, can't we boil the Bible down to just one word? And he's like, okay, Nick, what are you saying? And I said, it's about truth, right? It's not somebody's convenient lie or inconvenient truth. It's just the truth.
Mm.
And that's what we're seeking. And we need to be, listen, you and I both busy guys, right? We got families, we got a lot of moving parts, right? It is very easy to just have a lot of information put before us and we just kind of go, screw it, whatever you think's best, right? And we kind of throw up our hands. And what's going on in those situations? People are drowning us in all of this fancy jargon, right? Like, just even think about like the financial system. They send you those prospectuses if you put money into a fund, and it's 100 pages of the onion paper with 1-point font on it. Please, somebody tell me they've read one.
Yeah, right.
But all that does is say, yeah, we basically have no risk in this. It's all you take all the risk, right? But that's not how it's sold to you. It's sold as the panacea, right? This is going to be there for you forever, and it's going to make your wife and your family feel all safe and secure.
I've heard a couple of things about IBC over the years. One of them is that it is a strategy to maintain access to cash flow. Would you call that accurate?
Yeah. Yeah. I'm okay with that.
The other one is that it gets better with the generations. Like there's more usable capital in generations 2 through whatever than there is in the first generation. Is that accurate, or does that depend on the structure?
Yeah, I wouldn't say that, but like how I would refine that is whole life insurance is one of the few things that gets better as it gets older. So at the beginning, if I put in $1, I might get 60 cents to use. But 20 years from now, when I put in $1, I get $3 to use. So I'm okay with that. If you write me a check for 100,000 and I write you one for 300,000 that you get access to use and go build wealth with, are you okay with that? And just like Nelson walks through in his book about owning the grocery store, and he even talks about if you could pull off buying a bank charter, getting your hands on one, it's got a capital upfront expense, right? Like if we wanted to buy the McDonald's down the road here, it's $3 million. Are we going to take out $3 million in the first year? No chance. On average, you're going to make about $180,000 per McDonald's location. But I'll do that if over time I'm going to get a lot more back than the $3 million.
Yep. So you'll be there at the Rogue Food Conference. You and Kyle will be there at the Rogue Food Conference, February 5th through the 7th. and people can corner you and ask questions and those kinds of things. Anything that you would like to say, hey, we can't leave this unsaid before I let you go?
No, I just challenge everyone to be willing to rethink your thinking. Just Nelson left us with that gift. That's biblical, right? Like, be renewed in our minds, right? Like, just be willing to rethink your thinking and open to new ideas and be curious about solving problems that maybe you didn't even know existed.
Yeah. You're not God, so you don't know everything, and there's room to learn.
I appreciate that, Clay. Thanks a bunch.
Thank you. Thanks for your time today.
Yeah, appreciate you.
Really appreciate Nick and his perspective and the way he goes about sharing it, and his heart for people and them taking control of their own financial future and being able to make the difference in their family tree. So looking forward to next week on the Working Cows podcast. I'm going to be sharing with you an episode with Malcolm McLean. And maybe you know Malcolm, maybe you don't, but I'm sure you've probably seen some of his reels, and maybe, I don't know what all platforms he's on. But he's the guy behind Ranch Hacks. And so if you've appreciated Ranch Hacks like I have for many years, or a couple of years anyways, then you will enjoy this episode with Malcolm McLean, because we're going to look behind the scenes of Ranch Hacks and talk about his ranch and what he's doing on there from a management perspective, the animals and the soil health management and the finances and all that stuff. So it's just a cool opportunity to get to know him outside of a 1 to 3 minute video on whatever contraption he cooked up in his lab to make his life easier on the ranch. So I think you'll enjoy this conversation coming your way real soon on another episode of the Working Cows podcast.
We invite you to visit workingcows.net to subscribe to the show via iTunes or Stitcher. You'll also find detailed show notes pages, resources from our guests, and the industry leaders who have influenced them. For more ideas on putting your cows to work for you in a more profitable way, tune in next week.